Okay, students, the last video ended. I was starting to talk about current portion of long-term debt. So let me just start over with it. When you borrow money on a long-term note, if you're making monthly payments, then a portion of that debt is coming due within 1 year. So that portion that comes due within 1 year should be reclassified from long-term debt to current debt or current liabilities. Now, to do that, we often just title it literally current portion of long-term debt. And quite often you don't actually see an account on the books as current portion of long-term debt. Instead, the loan is just carried as notes payable. And as it says right in here, accountants often record the total loan in just one account, and then when preparing the balance sheet, reclassify the amount of principal to be repaid in the upcoming year as a current liability, current portion of long-term debt, and leave the rest as long-term debt. Now, it's the portion of the principal that comes due that is the current portion of long-term debt. Usually when you're making payments of both principal and interest. And so if you have a car payment and you borrow for 6 years and you're making payments of $600 a month on that purchase, then a portion of that $600 every month is interest. Now, at the end of this year, let's say at the end of 2020, you get ready to record or to prepare the balance sheet and provide the information on current liabilities and long-term liabilities. Then if your payments are $600 a month, and you might look up and think, okay, I have to show 600 times 12 months or $7,200 as current portion of long-term debt. Well, the answer is no, that's not what you do, because a portion of that $7,200 is interest. Now, do you owe that interest for next year as of December 31st of this year? The answer is no. That interest accrues over the next year. So all we do is record as current portion of long-term debt the amount of principal we're required to pay in the next year. So let's say out of that $7,200, that $6,000 of it is principal. So then we would show current portion of long-term debt as $6,000. And whatever our total debt is, let's say it's $26,000, then that we would show out of that $26,000 total amount due on that's still owed on the note, it shows $6,000 as current portion of long-term debt, and the other $20,000 as long-term debt or a long-term liability. Okay. Now let's move on down. And we have a homework problem dealing with that. So let me go to the homework problems and mini exercise 10.5 right here. And let's see, on December 1st, 2018, your company borrowed $15,000, a portion of which is to be repaid each year on November 30th. Specifically, your company will make the following principal payments. So 2019, $2,000, 2020, $3,000, 2021, $4,000, 2022, $6,000. So we add all those up, that comes to the $15,000. Show how this loan will be reported in the December 31, 2019 and 2018 balance sheets, assuming principal payments are to be made when required. Will be made when required. So December 31st, 2018, first, we have just borrowed the money, and so we haven't paid anything back. And so we're going to ignore interest here because it doesn't tell us anything about interest. So the current portion of long-term debt will be the $2,000 due November 30th of 2019. This is at the end of 2018, so that $2,000 is coming due within the upcoming year. So that's current portion of long-term debt. It's a current liability, $2,000. And then the other $13,000 is long-term liability. So there we have it. So here's December 31st, 2018, $2,000 current portion of long-term debt, $13,000 long-term debt or non-current liability. Okay, then December 31st, 2019, we have paid off this $2,000. So we now only owe $13,000, and now $3,000 is due within the next year. So that $3,000 becomes current portion of long-term debt, and this $10,000 here is long-term debt or non-current liabilities, whatever you want to call it. So there is 12/31/2019, $3,000 current portion of long-term debt, $10,000 long-term debt or non-current liabilities. Okay, I hope that covers that well. Let's move on down. They get into a discussion of bonds, and a bond is a financial instrument. Here's an example of what one looks like. And basically, bonds are just a way that corporations or government entities, for example, cities or universities, will issue bonds to borrow money. And so it's a way that someone or some organization, not a person, people don't issue bonds, but an organization borrows money. So if it's a corporation or a government entity, they issue what are called bond certificates. So you see an example of what one looks like here. This is from General Mills, and 6% interest rate. Series bond, which means they're paid off a portion of them every year, and for $1,000. And so let's just say it's being issued at face value. Now, I'll explain more about that in a little bit. But anyway, whoever buys this bond is loaning $1,000 to the business. Now, the important question you need to understand the answer to is this. When somebody buys a bond, what are they paying $1,000 for? Are they paying $1,000 for this nice little sheet of paper? Well, if your answer is yes, I would like for you to come see me, and I will make a lot of really pretty nice pieces of paper and sell them to you for $1,000 a piece. But obviously, you wouldn't want to do that. So they're not paying $1,000 for this sheet of paper. What you're actually buying with the bond is cash flows, and usually 2 sets of cash flows. Now, let's say this one's due December 31st, 2021. It's being issued January 1st, 2018. So we have 2018, 2019, 2020, and 2021, 4-year maturity on the bond. And I cannot really read all of this very well, but pays interest at 6%. Semi-annually, I think it's saying there, which means they would make 2 interest payments a year. Each one would be half of that 6%. So $1,000 bond, 6% would be $60. So they're paying $30 twice a year, probably June 30th and December 31st. And so what you're buying is that 2 sets of cash flows. Number one, you're going to get $30 every 6 months over the 4-year period. So you're going to get 8 of those $30 interest payments. And then at maturity on December 31st, 2021, you're going to get $1,000. So how do you value that? Well, the answer is you take the present value of those 2 sets of cash flows. present value of $1,000 4 years from now, plus the present value of a series of 8 $30 payments over the next 4 years. And you get the present value of each of those cash flows, you add them together, and that's what you're willing to pay for the bond. Now, let's say you've used 6% as a fair interest rate, so that's your discount rate. Well, then the present value of those cash flows is going to be $1,000. So the bond would sell at face value, which is right there. It's on the face of the bond. Now, let's say a fair interest rate was 4%. Well, you're paying, the seller of the bond is paying a higher than market interest rate. So the bond would sell at what's called a premium. And what that means is that the buyer actually pays more than $1,000 for the bond. And what they're doing is actually kind of upfront refunding some of that money they're going to be paid in interest. So if that bond sells at a premium, let's say it sells for $1,050, then at maturity, the holder of the bond is still only going to get $1,000. So what's happened is they've gotten 8 of those $30 interest payments. Well, that would be 8 times $30 would be $240. But let's say $190 was the fair amount of interest they should have received. Well, they have refunded $50 of that by buying the bonds at a premium. So if 8% was a fair interest rate, then the bonds would sell at a discount, meaning the buyer of it would pay less than $1,000. So let's say they paid $900 for the bond. Well, then what happens? At maturity, they're still going to get the $1,000 face value. So that extra $1,000 they're getting over what they paid for the bond, they paid $900 for it. At maturity, they get $1,000. That $100 is just more interest they're actually collecting. It doesn't look that way, but that's what it is. They paid $900, and then they're going to get the $240 in annual interest in the semi-annual interest payments, $30 per interest payment for 8 interest payments, plus they're collecting an extra $100 above the price they paid for the bonds. So instead of getting $240 in interest, they're effectively getting $340 in interest. They're getting the $240 in 8 payments and then getting an extra $1,000 above their purchase price when the bond matures. So that's bond. Your book explains that. They talk about a few things here. The maturity date, we saw that. That's when the bond becomes matures. That's when it is to be paid. The money is to be paid back. The face amount is paid back. That's right here, the face value or face amount. And that's the amount that's the stated amount the bond is worth up front. It's not really what it's worth, but it's just what's stated. At maturity, you're going to get this amount of money. The stated rate was the 6% that's stated on the bond. And those are important for calculating the cash flows that the buyer will get. They'll get the face amount at the maturity of the bond, and their interest will be calculated by taking the stated interest rate times the face amount, times the portion of year that interest payment covers. Okay, so to get into bond pricing, I talked about the present values, and so they get down here to the premium or discount. My time is about to run out, so I will talk about that again on the next video.